Well, joining us now for his thoughts on the Fed, the outlook for stocks is Traxis Partners managing partner and former Morgan Stanley chief global strategist Barton Biggs. And Barton, always great to have you on our airwaves here. And, you know, let me talk to you first about GDP. Came in line with expectations. Kind of supports the view, though, that the Fed should continue to ease monetary policy. Is this supportive of stocks?
Yes, I think it is, Betty, and both the inflation numbers and the GDP number came in line with expectations, and it confirms the case that we're still in this soft patch. And you know, there are some activity signs, particularly in technology capital spending, that would suggest that business is improving. On the other hand, the most recent high-frequency data from the housing market is very disconcerting. So
right.
we're still tipping along the knife edge.
Right, tipping along the knife edge. But what's the case for buying into stocks now, though, Barton, when we've had a pretty good run-up since the end of July and beginning of August? Part of that having to do with this expectation of quantitative easing. Well,
I think the conventional wisdom is that the rally since July stemmed from Bernanke's speech at Jackson Hole,
right,
talking about quantitative easing. And so the markets have discounted some amount of quantitative easing, and they've discounted the election. And meanwhile, all this liquidity that it is being created. And so my judgment, and I may be completely wrong, but the conventional wisdom is the markets are going to probably sell off after the election and after the Fed's quantitative easing announcement. My view is that the surprise could be, the so-called pain trade could be that that we have another 10% rally after the announcements, and just beginning maybe next week. Because I think there is enough evidence of progress.
Right. So I want to be clear. So you see sort of a knee-jerk initial selling reaction right after quantitative easing, but that may be the time when you start getting the buyers to come back into the markets, right?
Yeah, that's my guess, but I emphasize guess, G-U-E-S-S. I mean, and so it's by no means a certain, but that's the way I'm playing it.
Okay, that's the Barton way of playing the markets. Then, if you are okay, so going into the markets though, Barton, tell me what is the most attractive play for you then?
Well, I think the most attractive plays for me on a higher risk basis are groups like technology in particular, and I think tech is still going to be a focus of strength, and I think other areas like oil service are oversold and attractive. The drug stocks, things like that, are in the U.S. And look, the emerging markets. I went to a conference this week. The emerging markets are the favorite of investors, but I think
are they a favorite of yours, Barton?
Definitely, and I think we're only halfway along the way to a gigantic eventual bubble in the emerging markets, but we're not there yet, and the fundamentals are too strong and too good. There's too much growth, and the valuations are still reasonable. So I think the emerging markets, particularly Asia, are a place where I want to have a really major representation.
You mentioned in particular that we are halfway to this emerging markets bubble. And some would say, look, with the Fed easing and the dollar going down, being debased, we are almost there with this bubble.
Well, I don't know what you mean by almost there. I mean, a bubble really.
Well, for instance, China is now coming out trying to make moves to stem all that speculative money going to the property markets. There's already problems peaking, is what I mean.
Yeah, no, there are, of course, and there's going to be more problems, and amazingly, China is dealing with its problems very effectively. And so in the run-up to a bubble, to a really big bubble, there's going to be all kinds of mini bubbles. But we're in a bubble-prone world to begin with, and particularly when we have something like a massive quantitative easing, increasing liquidity all around the world, it's going to make the world even more bubble-prone.
Right.
But bubbles always come out of some form of reality. And so we're still in the reality discovery stage in the emerging markets.
Right, but shouldn't we be doing something about this then at this point? I mean, rather than let it happen, shouldn't we be doing something about it?
Hey, look, we are doing something about it. The Fed, the world economy is in a very dangerous position, and I don't know which way it's going to tip. I'm hoping and betting that we're not going to have a double dip. But the Fed is doing the right thing. The Fed is pumping massive amounts of liquidity in. Our government is not doing the right thing. We're still yammering away about fiscal austerity. We need more economic growth, and we need to make sure that we don't tip ourselves and the world back into another recession. And then the price of that is going to be a bubble at some point. But a bubble in emerging markets, as it develops now, is actually going to be, in my view, positive for the world economy in the short run. I mean by the short run,
right,
the next 6 to 9 months. Okay. What happens after that, we got to wait and see.
But Barton, don't you, you were just saying that, we're dealing so much with fiscal austerity, but don't you think, though, at some point it's going to get very, very ugly for us in the Treasury markets? Don't you think that?
Yeah, I do think that. I do think that. I am. There's two schools of thought about the way this thing is going to end. One is that we're spiraling into a vicious cycle of basically deflation.
Right.
The other is that we're going to have hyperinflation, and I think that the outcome is going to be more stagflation, and that's going to be eventually very bearish for Treasury bonds.
Okay. All right, Barton, we've got to leave it here, but I know you'll be joining me again next week, so I look forward to that. Barton Biggs, there of Traxis Partners, joining us.